नमस्कार दोस्तों, this is the last part of technical discussion with Shri Dhananjay ji Gokhale, which will help you in audit and finalizing your balance sheet in a correct way. This fourth part, we are trying to cover up couple of things which are not advised by Reserve Bank of India and couple of things which are already there, but then we are not paying proper attention to it. So all these couple of small questions, small queries, we would like to address them. So you will find that the questions that are being asked are not in sync for the simple reason they are on variety of topics, variety of issues which the urban cooperative bank faces. Thank you, Dhananjay, for joining us on this small discussion. Uh, I would like to start questioning on the basis of the softwares which are being used by the urban cooperative banks. They are all CBS oriented.
Right.
But then many of these softwares are not giving the desired results. Maybe the fundamental principle of garbage in, garbage out, that is going on. And then the users are making some errors, and therefore the related area which applies over here is that Reserve Bank of India expects you to give system generated NPAs, and then there is no software in the world which is giving you 100% result. So what are the points, or what would be your advice to banks to remain compliant with Reserve Bank of India's guidelines, as also resolve the things practically with transparency? So what's your call on that? What's your take on that?
See, actually, there is a long history for this automation. Long back in September, somewhere in September 2010, RBI had came out with a circular, or rather, it was not a circular; it was a letter which was sent to scheduled commercial banks, wherein RBI has already advised them to ensure that IRAC norms are automated. In the sense, there should not be any manual intervention. After 10 years, they issued another circular in September 20, asking the same thing repeatedly again. They gave a deadline. Similarly, the same deadline was given to the cooperative banks with a little later date. Now, what RBI is expecting is that RBI is expecting that there has to be a seamless automation of all the IRAC norms. So, just to put it in nutshell, each and every clause which is there in IRAC master circular, that is supposed to be complied through software without any manual intervention. At the same time, RBI also gives a leverage that wherever a bank is doing a manual intervention, the bank needs to maintain a trail. It has to be preserved also. Now, for this manual intervention, there are additional guidelines also which RBI has specified. One is that there has to be a board approved policy wherein it will be stated that under which circumstances the manual intervention will happen, at which level the manual intervention will happen, who will do that. That is it's a kind of a delegated authority. Naturally, it is not meant to delegate till branch level. Means someone at the apex level has to do that, and maybe depending upon the gravity or value, it can be decided. Another thing which RBI has categorically stated is no back-end changes are permitted. So whatever changes are supposed to be done, those are required to be done at front end and not at back end. Plus, audit trail is required to be maintained. Now, the challenge before banks are in two folds, I will say. One is that banks are not getting any written assurance from the CBS vendors, wherein CBS vendor is giving a written assurance that IRAC norms are complied. That's the biggest starting point actually for the banks. So what is really happening is that typically the banks are supposed to test that software, satisfy themselves about the functionality of that. Ideally, they need to go to external agency annually, and they need to again ask that agency to test that software. There has to be a test environment also. Now, all these things, what are these things are really harping on is RBI doesn't want any delay in identification of NPAs. So at end of the day, every end of the day, every asset will be tested for NPA norms, and based on that the classification will happen. So income recognition, asset classification and provisioning, all these three things are in sync. There is no delay which is expected for that, even for provision, because many times the provision entries may not get passed instantly. So firstly, your CBS should be equipped with that. Secondly, the CBS should be tested. Typically internally, you can call it as a UAT, but I will go a little step further. UAT has a limited ramification wherein the user will only see that whether its operational part is covered or not. And when you are talking about internal testing, it talks about all the test cases which are required to be run, and maybe external agency might be deployed wherein you can have a certification from their end as to whether the automation is really happening or not. Now, the crux of this matter is that every para which is there in IRAC, that is required to be followed. So there are typical issues, or I should say tickling issues, wherein CBS vendors are not able to capture that. Because on one hand, just to give an example, a simple example, on one hand, RBI says that classification should be custody wise, that is borrower wise. On the other hand, there are n number of examples wherein there is a deviation from that. For example, a borrower might be having a NPA loan, maybe related to machinery loan. He might be having a advance against FD, which will always remain into PA. If it is a central government guaranteed account, it will remain into PA. If it is a restructuring, all other accounts, if they turn into NPA, additional finance will remain into PA. So there are challenges in that. What is important is that one needs to understand as to what kind of data is required to make this automation work. So for example, if you're talking about non-renewal instances, for cooperative sector banks, if a account is not regularly renewed in 90 days, the account falls into NPA category. Now, if a bank does a short review of 90 days, there is no separate data field which typically is available in CBS system to distinguish between regular renewal and short review. So if you don't have the master data captured, practically you cannot have automation worked on that.
But then typically, when you talk of the renewals and all those things, there would be events occurring beyond the system. How the system will capture? For example, a branch feeds a stock statement and there is no stock.
Yeah.
How system will capture it?
See, as far as any fictitious statements part is concerned, which is more akin to a fraud actually, system can never capture that. But again, just to give an example related to stock statement, suppose a stock statement is received on 20th of a particular subsequent month. Ideally, the effectiveness of the DP should be from 1st and not from 20th onwards. So the software should be capable to take up this matter and do that correctly. Even the basic, I should say, basic requirement from the software is like overdue calculation should be correctly done. Stock DP calculation has to be correctly done.
They want SMA 0, SMA 1, SMA 2 also to be identified
Precisely.
through the system.
Precisely.
No software is in a position to do that.
Software, it's not a question of whether they are not in a position to do that or not. They are probably they are not able to implement that in their logic.
Bucket it in a proper fashion.
Yeah.
Because every CBS system will give you the number of
Correct.
days for which it is overdue, from which it can be classified into these three categories.
Another challenge is that it is typically perceived in banking parlance that IRAC is customized. That is not the reality. You don't have any customization for IRAC which can be really carried out in a CBS vendor, CBS software. So as far as CBS customization is concerned, it's more about operational side, not related to regulatory norms. Right. Regulatory norms has to be hard coded. There cannot be any deviation. Like if a bank says that instead of 90, make it 95, that is something which should never happen.
Never happen.
So there is no question of customization as far as IRAC norms are concerned. So the struggling part on part of CBS and bankers is, according to me, is a little different part, wherein functional testing of the software is lacking to a greater extent. Sufficient test cases are not run. So sometimes a software might be running well as on today, but maybe certain different kind of assets or kind of scenarios arise, and CBS goes for a toss because that is not inbuilt into that.
For example, typically the bank faces a problem is that suppose they are having 25,000 borrower account, and in say 100 account there is always variation.
Yeah.
The concept of materiality comes in. The number of accounts are 0.0001%,
Yeah.
so it's not significant. You said that there should be a board approved policy which will track this. So what kind of clauses board for these 100 accounts, it will have to be intervened humanly for the simple reason the account has been wrongly either classified as PA or wrongly classified as NPA, either way. So what kind of audit trail you would like to maintain where you make a human change, or how is that?
See, ideally that audit trail, apart from the changes which are made, it should always note down the reasons why that deviation is occurring, in the sense why that exception is occurring.
But then how the operating staff doesn't understand how the system functions.
Exactly. So it might happen that there is a one-off case, wherein the behavior is not understandable. See, because when we are talking about exception, that exception cannot become rule. For example, suppose someone says that in a CCOD case, SMA classification is going on wrong. Or for example, out of order condition, only first condition is satisfied, second and third is not there in the software. Now, this cannot be exception. This is a flaw in your software. Now, you cannot have a board approved policy to overcome a flaw which is existent in the software, but at the same time, from the banker's perspective, the challenge is that even if they have escalated that to the CBS vendor, and if the CBS vendor hasn't acted upon that, it's a kind of a deadlock scenario. So my personal suggestion is that it's better for the bank also to document all these things, wherein
The documentation will make you escape the regulator's wrath because you have documented everything.
Even I'm having a doubt even about whether you can really escape, because the regulator will say that you are aware about your CBS software which is not functioning well. So why you are still sticking to that software? And the bankers will not have an answer.
The banker will not have answer because it requires capital investment. That is the only difference that is.
But then,
coming up.
just to take you a little backward, when RBI mandated all urban cooperative banks to migrate into CBS system.
That was 2013.
Correct. So prior to that also, there were n number of softwares which were in prevalent. Like typically branch level softwares were there. All banks migrated to that. Now what RBI is expecting is your entire business is run on a CBS software. So if your CBS software is not complied with the regulatory guideline, practically you shouldn't be using that software. It's as simple as that. Capital expenditure is a secondary thing. So like IRAC norms, just to give an example, suppose a bank says that interest calculation is wrong in my CBS system. It can never work. Same way, when you are disclosing your financials and other things, the IRAC norms are having a ramification to a greater extent. So I really doubt whether it will work on long run basis. Short term, it's fine that you can demonstrate.
There is one more typical issue in that particular circular, which they are saying that even the provisioning you need to draw it from a system.
Correct.
Now here is a typical case where the valuation of security is fed into the system, based on which the provisioning will come.
I agree.
Now, typically the CBS system is not in a position to factor in the valuation numbers which are being fed into the system, and all provisioning requirements are coming wrong.
Yeah, I will like to answer this from auditor's perspective as to how the auditors typically question the bankers or how they are supposed to question the banker. We'll see couple of possibilities in that. First possibility, let's take a simple example of a vehicle loan, wherein say 3 years back a vehicle of say a vehicle costing 10 lakh was purchased and now the account is NPA. The 10 lakh value is already fed in the system 3 years back. Typically, I have never seen a CBS software which will gradually deteriorate the value of that, like a depreciated value, because they are not capable to handle this scenario. If you look at it from theoretical part, whether it is PA or NPA, your security value has to be correct. So best way, or I should say ideal way, I will say, because at times these ideal ways which the auditor will suggest, they are typically called as impractical ways. But at the same time, when you don't have a control over your security value, if you are not having a practice to revisit your security value, your entire IRAC norms go for a toss. So suppose that 10 lakh rupee costing vehicle, maybe now it is costing only say 4 lakhs. I'm just giving a hypothetical example. That 4 lakh, if the manager or if the branch fellow is manually feeding into that, there is a chance of manual error. What the bankers are supposed to graduate using the CBS, means I will rather say the CBS has to graduate, that a bank should decide a policy that based on type of security, bank will presume that it has to be staggered in say 5 years, 6 years, 7 years, whatever is the case, or maybe 10 years.
Value deterioration should be linked to the EMI repayment, so it matches, or how do
it has to be practically either a expected value of life of that asset, which typically will never go below the loan tenure. If you look at it, because if it is going below loan tenure, you will not finance it. But it has to be linked somewhere and it has to be uniformly followed. But this is not happening right now. I will give you another example. When in RBI has mandated that wherever you are having a valuation report of immovable property which is older than 3 years, you are supposed to do a valuation once in 3 years. For cooperative banks, the norm is 10 lakhs and above. At the same time, the 10 lakh norm can be increased by way of a board resolution. So many banks miss it out on that. So presuming that it is missed out, so it is 10 lakh. Now once you go above 10 lakhs and if you are having a immovable property as a security, ideally the auditor should ask the bank as to what is your policy to deal with such scenario. Ideally the bank should have a stringent policy wherein this rule is followed, because otherwise you are deviating from the norms.
Right.
Now problem is that CBS softwares are not equipped to act upon that. They have the valuation dates, but they don't act on that.
Out of frustration, therefore many banks say that RBI should give us the software, where RBI will never give us software because that's
it's not their job actually.
It's not their job. Your job is to ensure that your software complies with the regulatory standards. Coming back to the recent guidelines which has come up for the company form of organization is audit trails, maintenance of audit trails. So as far as urban cooperative banks are concerned, there are no guidelines in respect of maintenance of audit trails. Normally, the banks on the basis of that Negotiable Instruments Act provision purchased the data and kept it in a separate place, separate this thing, storage. So audit trail, as far as the systematic NPA classification on system and all other transactions, what are your views on audit trails and how it has to be preserved in soft
Yeah.
form or whatever?
Actually, the new guidelines about company under Companies Act, and they are more or less anyway were applicable in Companies Act. It is only getting formalized. Now, what is really mean by that is, whenever you are making any change in your system data, be it rate of interest change, be it security change, be it valuation change, anything that should be captured and that should be retrievable. So suppose I am an auditor, or suppose I am I should say credit monitoring cell person, and if I want to have a report, a kind of exceptional report wherein the rate has been changed beyond 1%, say in last 6 months, then I need to have a data dump available with me wherein I can segregate this data. In short, audit trail is nothing but any changes which are made in the system gets captured. So for example, name is changed, account operating instructions are changed, anything and everything will get captured, and that should be retrievable. Best form of audit trail is that if you have a menu driven audit trail retrieval, that is the best thing to work, so that you have conditions which can be set. Otherwise it will be a huge dump wherein each and every
Yeah,
change of master
yeah.
data will happen.
It will
But
be
again, that
difficult.
will again depend upon the software vendor as
Yeah.
to how refined he can give it to you.
Yeah. There is one more area which has been bugging the banks, and there is a lot of confusion about that. There are four words I would like to explain, decipher, break, and how it impacts the quality of assets. The one is moratorium, the second is restructuring, the third is reschedulement, the difference between the restructurement and reschedulement, and the DCCO.
Yeah.
These four areas where Reserve Bank of India inspectors constantly harp on banks and find out their errors.
Yeah.
There is a time, there is a need to ensure that banks understand this thoroughly well.
Yeah.
So, would like to request you to talk on moratorium,
Yeah.
its impact, and what is required to be followed. Then we will come to restructuring, reschedulement, and DCCO.
Sure. So as far as the moratorium word is concerned, it's only a kind of a repayment holiday which the bank gives to the borrower as a part of sanction terms. So we'll come on both sides actually, pre-facto and post-facto. So we'll first talk about pre-facto thing. When the bank is giving a sanction letter, let's take an example that for first 6 months there is no EMI and interest has to be paid on as and when basis. So it means that for first 6 months, interest will get debited in the account at the end of every month. EMIs will start typically after 6 months. So there's a moratorium period for EMI which is given. Bank can also give a moratorium even for interest portion also, where it can say that for 6 months there is no amount due. After 6 months, you have to pay the entire interest at one go, and later on EMIs will start. Third, another example or variety which is possible is banks might fund that interest also. Now that's where that pre-facto word I wanted to use. So suppose my 100 rupees is my limit which is sanctioned. The actual disbursement as a bank I will do is only for 95. And let's say for next 6 months, I am funding the interest. So interest will keep on getting capitalized. And after the end of tenure of 6 months, which is a moratorium for interest also, it gets capitalized. And then on 100 rupees, EMIs will be paid. Now all these things depend upon the sanction terms. Now one important factor over here is, when we talk about the first two cases, interest was payable as and when. So as and when the amount was hitting to that account, it was due immediately. It has to be paid. If it is not paid, it is overdue part. Second phase, that 6 months there was a moratorium period. So for 6 months there is no amount due. So even if the amount was debited in the account, the amount was not due. So it was not overdue. No question of SMA 0 or NPA classification. Third example is that, interest we are capitalizing, and that's a pre-facto sanction. So this interest capitalized, later on suppose this account turns into NPA, as all of us are aware about that, the moment the account turns into NPA, you have to reverse the unrealized income. Now this third case where that interest is capitalized, it will not be considered as unserviced interest because it is funded by you as a pre-facto sanction terms.
That can be taken to P&L.
That is taken to P&L and it is not required to be reversed. Whatever is after 100 rupees, naturally that will be reversed.
Right.
So that's how this moratorium will work out. Now let's take little different kind of example about post facto. Like suppose a bank wants to fund interest post facto. So that is typically a case of FITL, funded interest term loan. That is, interest is already hitting my account. I am carving out that interest out of that account and I am creating a term loan account. So there the norms are very clear that you have to make a 100% provision on FITL because you cannot recognize the income by way of funding. So that's why I said it is post facto, because first the account is already hit with that interest,
Right.
and later on you are funding it.
Right.
So for your interest, you are funding on your own. So 100% provision is warranted.
Yeah.
So that's all about moratorium.
Uh, a loan has been sanctioned and somewhere borrower finds it difficult to repay.
Yeah.
Can the moratorium be granted in between for reasons beyond the control of the borrower? मेरा company चल रहा है, I have taken housing loan, suddenly my company is shut, I am not in a position to repay. I say that grant me a 1 year moratorium, I will go and engage myself and then start repaying. Can the bank do that? Or what is the best way in such a case?
Operationally, bank can do that, but it will amount to a restructuring process.
Coming to that, what is restructuring? How do you do that?
Yeah.
I mean, probably the linkage word will be rescheduling.
Yeah, actually restructuring, reschedule, whatever we call it, the concept is that if you are passing on some economic benefit or a financial benefit to a particular customer on a standalone basis, it will amount to restructuring or reschedulement. So let's talk about a couple of examples of that. That what will not be considered as a reschedulement and restructuring. So for example, suppose you have a customer wherein rate of interest is at 10%, and that customer has got a better offer from other bank at say 7%. So you match the offer, you reduce the rate of interest. It's not a case of restructuring. It's more about retaining your customer, and that has to be proved on record that he had an offer from other bank and that's why you reduced that. Another example is that
so the reduction of rate of interest as a commercial decision will not tantamount to
exactly
restructuring.
Right. Like credit rating is improved, so you reduce the rate of interest.
Okay.
Or the borrower negotiates with you, but otherwise the borrower standing is too good.
Okay.
That you have a fear of losing that particular customer.
But then if he seeks the retrospective effect, then how it will be interpreted?
That is the operational part. Means bankers have full discretion about that. Usually one will not go backwards beyond a point. Typically what is expected from the banker side is whenever he applies for that rate revision, decision,
that is the effective date.
That can be the effective date. You cannot go prior to that.
Prior to that, because he makes a demand. मेरे को ये तारीख से चाहिए, ये तारीख से चाहिए.
Bank can take a business call.
Take a commercial
call. Ideally, one should not go
beyond that.
Because at least he should initiate the request that I want a rate revision. So that is one. Secondly, if you change the rate of interest across your portfolio, like say housing loan portfolio, you do a 50 basis point rate cut.
Or rate rise.
Rate rise, either way. Rate rise anyway will not happen as a restructuring. Yeah. It's a gain for you and loss for the customer. So that's not restructuring. But if you do it across the portfolio, it is not considered as restructuring because you are not giving a benefit to a particular borrower.
You are giving extra across spread.
Across the spread. Now, what will happen in another peculiar case is, suppose you have a term loan and term loan gets converted into a OD. It's a typical case of restructuring. The reason being you are postponing or delaying the repayment because now principal amount is no more repaid. But vice versa, OD converted into a term loan, that is not a reschedulement or a restructuring because you are asking that prepayment earlier than what was scheduled as a OD. Another simpler yardstick actually to check whether it is a reschedulement or not is if there is a rate of interest change favorably to the borrower on a standalone basis, or there is a increase in tenure, or there is a reduction in rate of interest, or there is a ballooning of EMI, either of these wherein the cash flows are delayed, all these things will amount to a restructuring. So if any of the things are happening, it will be a restructuring. But replacement of security, changing the terms of security which are favorable to the bank and not favorable to the borrower, all these are normal cases. I mean, they are not called as restructuring.
Now, typically, when we go for restructuring, there is a provision under IRAC norms about the special regulatory treatment. Wherein there are certain categories of borrowers, if you restructure them, you don't have to downgrade.
Correct.
How that has to be implemented, if at all there is an eligible case?
See, now in that case, what RBI has continued to give leverage to the cooperative sector banks is because that leverage is no more there with scheduled commercial bank. The leverage is that if you do a quick implementation of restructuring package, quick implementation means from the date when that application is made to you by the borrower that restructure my account, if you implement it within 90 days, subject to the terms, the terms are specified in the circular itself, like capital contribution, capital commitment, and in number of viability check and other things. Then there is a one-time benefit which is given, wherein retention of class benefit is there. It means that if you are having the standard asset,
it need not be downgraded.
It need not be downgraded. If it is second time restructuring, it will get downgraded. Now, in that 90 days norm or 90 days quick implementation package, one has to ensure that what is completeness of that restructuring. So it starts from the date when the application is made, then appraisal, viability check, all these things will happen. New sanction letter will be issued, maybe documentation, certain documentation the bank will do, and then it will be fed in the master data of the system. Till this entire process is not completed in 90 days, then only
SRT becomes
SRT will be applicable. If it is on 91st day also, it's a restructuring, it has to be downgraded.
It has to be provided for as also
exactly.
simultaneously.
But just one point which we missed out, which you had mentioned about DCCO. DCCO per se will apply only for project loans. So project loans are typically term loans wherein they are given to set up an economic venture. An economic venture can be anything. Setting up an office or maybe a factory, electricity generation unit, hotel, whatever it is, hospital, anything. Now when these term loans are given, the bank is required to predefine I should say, that what is the DCCO of that, that is date of commencement of commercial operation. It only indicates that it's the expected future date by which the commercial operations or commercial production will start off. So there are additional RBI guidelines related to that. So if a particular unit is not able to achieve the DCCO, that is the commercial production is not starting off by that date, then in that case what will happen is the account will be also required to be marked as NPA. So account need not have met 90 days norms delinquencies. Account is regular, but commercial production hasn't started off. So it's additional risk which is perceived. So the account will get marked as NPA. But at the same time, RBI has given certain leverages wherein DCCO can be extended. There's a detailed commentary on that. There are certain circumstances like say court cases are there. Then for infrastructure there is an additional facility wherein
Some
DCCO can be
delays there.
extended.
For genuine reasons, if there is a delay, DCCO can
Now
be
there
extended.
also RBI has given that leverage conditionally. So for example, under the RBI norms, suppose 2 years extension is permissible. What it says is if you go beyond 2 years, it means that the conditions are violated. It is presumed that it is a restructuring, account will get downgraded. Or someone has extended DCCO by 2 years, but the repayment schedule has been extended for 3 years. Then again it is a restructuring, because to the extent of DCCO extension only, you can extend the repayment
The
schedule.
moment restructuring comes in, it attracts provisioning unless otherwise under SRT.
Yeah.
You have to make a provision.
Yeah.
The moment you either extend DCCO without proper justification, you go for provisioning in that case. Treating the account as NPA for a period of what they call it as a cooling period, say 12 months or something like that. You have to make a provision on that. There is one more area which we have not discussed, is that the NPA is in investment portfolio, and typically the March is the period where under the maintaining low mark to market, that is one of the risk, and then strategizing in terms of shifting. So all these activities are slated into the first quarter of the year, and then shifting among the securities should be at the beginning of the year. What is the exact meaning of the word beginning of the year? Now, beginning of the year could be September also, because the year is not yet completed. I do shifting in the month of September. How RBI will view this, and what are the advisories for the banks? What that they should not do this, because there was a bank which was saying that beginning of the year में December में shift करेगा तो भी चल जाएगा, क्योंकि ये मेरे लिए beginning of the year ही है ना. So how do you view that?
See, as far as non-performing investments are concerned, almost same logic is extended like IRAC norms, like 90 days delinquency. So suppose you are having a corporate bond and interest or principal is due and it is not paid in 90 days. So it becomes overdue beyond 90 days. That investment is called as non-performing investment. But there is a difference in IRAC norm provision and investment provision. Investment provision warrant for 100% provision.
So there are no stages.
There is no stage. There is no secured, unsecured. There is no substandard DA1, DA2, DA3. Either 100% or 0%, because
but if there is sovereign guarantee, then the provisioning is not required. How is that?
Typically, such exposures will never turn into NPA. But presume that, suppose there is a PSU bond which has turned into NPA. Circular of investment doesn't support that. IRAC circular supports that, wherein advance is guaranteed by central government. You are not supposed to mark that as NPA.
Correct.
Similar guideline is not there in that, because it is presumed that it will never occur. Secondly, what will happen is, as far as NPIs are concerned, the provision is in the form of provision for NPI and not IDR.
Okay.
So a ticklish point might happen that the same security will have one portion as IDR, one portion as provision on NPI.
Okay.
because first you have to do mark to market, that is IDR. Balance remaining entire portion will become your provision for NPI.
Okay.
So that's a slight difference in accounting or disclosure, I should say.
Okay. Okay.
Now talking about shifting of securities, as far as shifting of securities is concerned, what RBI is saying is it has to happen once in a year and beginning of the year. Two important parameters are there. Now these parameters are only for shifting from HTM to AFS or HFT or vice versa. AFS, HFT internal, there are no such category guidelines are there because both are trading portfolios. Now beginning of the year per se doesn't mean that before March. It essentially means that immediately after March. So ideally the bank should be able to identify the securities which they want to turn from long-term portfolio to a trading portfolio or shift from trading portfolio to a long-term portfolio, typically in the maybe first fortnight of April, and maybe that should get concluded by the end of April. One should not stretch beyond that because the very logic behind that is whenever you are taking a strategic call, you need to take a call for the entire year on a budgeted figures and not on the basis of known figures. So that's where the beginning of the year and once in a year is vital. And once in a year, what it means is, suppose you identified say 10 securities, all those securities will get transferred at one go on one single day. So the testing of that against the market value on that particular day will happen uniformly. It won't get staggered. So that's how it has to be dealt. It shouldn't be getting into September or December.
Okay. This BR Act was passed in September 2020. There are quite a few provisions which are bothering the banks. And Reserve Bank of India, while conducting inspection, is simply stating that you are not complied with BR Act provisions. The typical area that I see is the tenure that has been described under Section 10A, where a person can be a director for a period of 8 years. The Reserve Bank of India has not issued circular, and the inspectors are commenting. What could be the response from the Urban Cooperative Bank? That is the first part of the question. With the opening or virtual dilution of 56, which are the other areas which you feel that bank should be taking care of? For example, Section 29 for auditors appointment and all those things will come into play. They are rather have come into play.
Yeah.
So what is your view on all these 2-3 typical and difficult areas, or rather dicey areas? Why I call them dicey? Because we are waiting for the guidelines from Reserve Bank of India. How do you view that?
See, as far as director's qualification is concerned, broadly I will divide that into two parts actually. One is about composition of board, wherein 51% professional directors are required, and second is that 8 years tenure, which RBI has prescribed. As far as 51% professional board is concerned, most of the banks do comply that because there is a leniency in that. Because there they also talk about agriculture, accounting, banking knowledge. So there are a number of things wherein professionalism can be proved, and it may not get proved only for a person who is a novice, who has just graduated and entered into a bank as a director. Because apart from that, most of the things will be taken care of. So that's not really a big challenge. Bigger challenge is about 8 years. Now, when these amendments were made, there was nothing like retrospective amendment. What RBI did was, it was an amendment made to BR Act, wherein RBI removed certain, I should say, a concession which was given to a cooperative sector.
Insulation for the urban cooperative sector.
So what RBI said that, okay, this is a clause, you are insulated. It's not applicable to you for time being because of Section 56.
Now it is applicable.
Yeah. Now what RBI did, RBI just removed that concession by saying that not applicable word has been removed, so it becomes applicable. So there is nothing like retrospective or prospective. As on today, that is the law. You cannot say that the earlier the law was different. Law was same. There was a specific concession which was given. Concession has got removed. There was no separate BR Act for cooperative sector. BR Act was same. Only applicability was, I should say, kind of a concessionary to the urban cooperative banking. Now, once that gets removed, the challenge is that anyone who is sitting in the director's position for more than 8 years, he automatically becomes disqualified because of that section. Now, this automatic disqualification might, lead to various legal issues. Like, for example, if someone is aware that he is sitting in a board for 8 years and is taking decisions at the bank, decision can be anything, operational, recovery, or any matter. Now just let's compare that with any other act, like say Companies Act. Suppose in Companies Act, director becomes disqualified. His acts which are made on behalf of the company, those can get challenged in certain cases because he has knowingly done that. Now here also, director cannot say that I was not aware of the act, because ignorance of the law can never be a defense. I'm really skeptical about how the directors will handle it. Forget about the banks and other person, because if a person is aware that he is disqualified, it's very difficult for a person to answer any regulator as to why you have continued. Now,
I am driving you towards a very controversial area for the simple reason there is a provision in BR Act which is that any action which is done in good faith, whether
Yeah.
the person is qualified or disqualified,
Yeah.
is not normally challenged. That provision will be applicable to this particular issue
I
also.
agree that will apply till the time a director does that unknowingly.
Here, that is a dicey area.
That's a
Director knows
dicey
it.
area wherein it is known or he is supposed to know, but he hasn't acted upon that, and he has continued to get into a continued position to take a decision.
But then I see banks,
From bankers' perspective,
2020, this act became enforceable. Thereafter, hundreds of cooperative banks have entered into their elections, and
yeah,
hundreds of people. There are 28,000, 30,000 directors working in cooperative banking
yeah,
industry. They all have been elected because this particular law cannot be enforced via returning officer, which is under state law or a
yeah,
multi-state law.
yeah,
So who will do this? I mean, how?
yeah,
Uh, my question is not that. I
yeah.
mean, for example, the controversies are being continued. As a statutory auditor of the bank, what is your role? That is the key area which I find. How you will insulate your own position? You know that this is a violation that
And
has taken place. How you will respond to that?
I will again just compare Companies Act with this. Now, in both the acts, Companies Act as well as Cooperative Societies Act, whether it is state or central, there are certain sections which are asking auditors certain specific questions. So in Companies Act, about disqualification, there are comments, and in Cooperative Act, actually, there is no specific comment. But
Yes, yes.
leaving that aside, as an auditor, if I'm aware that a particular director is not qualified to remain in the director's position, I need to ask a question to myself whether a statement signed by a disqualified director can be accepted by me or not. So it's a very ticklish scenario as far as the auditors are concerned, because auditors are the last one to get into all these issues. Because firstly, it's the banker and the directors. It's the bank and the director. Secondly, if I take an extreme stand, just to give an example, let's take an example wherein the auditor gets a representation letter from a board which has a tenure of 10 years and more, which is already completed. Who will sign the balance sheet? Because technically everyone is disqualified. Now for auditor actually, now again I will put it in a little different perspective. If one wants to insulate himself in a very watertight way, he can write that as an emphasis of matter para by saying that this is what has happened. But balance sheet is true and fair, because both are different things. But that is something which I really doubt whether it will ever get accepted at any forums. The reason being, still there is a dilemma in the minds of banks and directors as to whether it is retrospective or prospective.
And even in the minds of
And
Reserve Bank of India,
yeah,
since they are not come out with the guidelines.
RBI need not have to come out with any guidelines. Their guidelines are clear. Why they should clarify something which is already written in the law? So it's like asking a Ministry of Company Affairs to say that why directors are disqualified. It's a law. It's a law of the land, and it is applicable to you. You are registered under BR Act, so that applies to you. Otherwise, how your license will continue actually, because banking license is given under BR Act. And if one starts arguing that BR Act will not apply to me, or BR Act has to be explained to me, or clarification has to be given, that is something which is a far-stretched thing. Problem with the auditor is that it's difficult for an auditor to get into a judgmental position, because that's where the controversies will start.
So the bank will always contest. I am waiting for the RBI guidelines. You want to do that as an emphasis of the matter. There is no scope for me to emphasize the matter.
Right. Now the problem will arise in a different way. Let's presume that suppose this point about 8 years is written in RBI's inspection report in a particular bank's case. So typically auditor has privy to go through the report. He may not be able to take the copy because that is prohibited, because it's a confidential report, but he has access to that report. He reads that report. He understands that there is objection which is raised from the regulator side. He has to deal this scenario in a very delicate way. There are various ways and means to deal with that. He can talk with SSM. He can ask the board to give a representation to him as to, in spite of that, how they can represent. But it's a balancing act. Now, even if I am saying this in a little, you can say, aggressive manner from auditor's perspective, in practical way, the auditor cannot get into a judgmental position. Now, what he should do actually? There are ways and means to deal with that. One way is that take a legal opinion. Secure your position by saying that whether this representation can be accepted by the auditor or not. But if the legal view goes in an adverse manner, auditor don't have any option actually. What best auditor can do is write a letter to SSM or RBI and tell them that, see, you have written that all the directors are disqualified. I am taking the extreme case. Now you tell me which balance sheet I should accept, because this balance sheet cannot be adopted by the board because you are saying that 8 years disqualification exists. And it's a kind of a deadlock now.
It's a deadlock.
Because if auditor goes on an extreme end by saying that...
the point I intend to drive is that with the Reserve Bank of India commenting in their inspection report everywhere, in almost every urban cooperative bank, and the statutory auditor simply not commenting on that.
Yeah.
And therefore the issue I broached.
I will just add one point. It may not be the case that the auditors are not commenting. Many times the auditor resorts to commenting in LFAR.
So they can do commenting in LFAR.
So that it's a kind of, I should say, a secondary mechanism.
Inviting attention kind of thing.
Yeah, so wherein they can demonstrate before the regulator that, see, we were aware, we have already flagged it. And only difference between audit report and LFAR is that LFAR is always addressed to the management. So it's not addressed to the public at large. It is not addressed to shareholders. Now the real question is that if a shareholder becomes aware about that, what next? Because the shareholder can raise a voice by saying that all of you are disqualified, you cannot conduct the AGM. It can go to that extreme stage. Better way to look at that is, it's better that law compliance should happen. Whether one likes it or not, ultimately it is the law which is applicable. There is no point in stretching beyond the point unless and until there is a stay which is given by a court. If there is a stay that there is a statement wherein this 8 years is stayed for a particular period, then it makes a sense. But if it is not there, it's stretching beyond the point from both sides actually.
From the regulators as well as from the bank.
The regulator doesn't have to do anything. Means my view is that regulator has already done his job. He has said that this is the law. You take it or leave it, because regulator will be in that position only. You take example of any law. The law can never get challenged. You can make a petition, you can make a request.
There are cases which have been filed for this particular case in various high courts.
Correct, but the high court till date
has not heard anything.
They haven't given stay. So if someone is not giving a stay, it means that you have to continue with the law abidance.
Because this typical controversy will hunt many banks in the country.
It's a legal issue now actually, that if someone is disqualified knowingly, can he continue on the position? Can he sign off the document? Can he take the decision? And then who will run the bank?
There is one more area which I would like you to talk elaborately. Well, this year, several changes have come in respect of certification by statutory auditor.
Yeah.
So, how will you advise them in terms of
advice to bankers or to the
auditors? To the auditors. Bankers are not aware. No? I mean, aware in what sense? They are driven by the auditors. Give me this, give me this, give me this.
Not really actually. What RBI is doing actually, RBI is sending a letter to the banks, asking them to forward this letter to the auditors and asking them to give a certificate. So it's always routed through bankers. Now, whenever any certificate has to be issued by any auditor, earlier, maybe a decade back or more than a decade back, the concept was that certificate were always presumed to be true and correct, which is not the status as of now. Today's status is even certificates are true and fair. There is nothing like true and correct in auditing or CS parlance.
It's always
so even certificate is true and fair. Certificate is no more true and correct. Secondly, when the certificates are asked, there are a number of certificates wherein auditors are practically not in a position to verify anything. I will give a couple of examples of that. One classic example is IRAC automation. Now for IRAC automation, all of a sudden since last year, that is 21-22 financial year, this certification has been added to be taken from the auditor side. Like till March 21, everything was between the regulator and the bankers. Auditors were nowhere into picture. Auditors were only asking that whether automation has occurred or not. They were commenting on that.
Correct.
Now they have been asked to certify that. Biggest challenge before the auditor is that if I want to certify something, I need to have a comprehensive testing which has to be carried out. For comprehensive testing, I have never seen a bank which is taking it in a positive manner and paying any fees to the auditor. Like suppose a functional testing of a CBS is required to be carried out from IRAC norms. If you go in the market and if you ask an external agency to do that testing, functional testing, I'm not talking about data security and other things. And suppose the fees are say 15 lakhs, I'm just giving a ballpark figure, or say 20 lakhs. I have never seen a bank who is ready to pay fees for that certification. So now the challenge before the auditor is, audit fees are governed by state laws in many cases. Multi-state you have discretion, but those are audit fees. Certification fees is always a matter of discretion between the banker and the auditors. Many times the auditors are confusing by presuming that audit fees are inclusive of certification. That is not the reality. Audit domain is separate, certification is separate. So one can always say that, look, for this certificate, this is X amount of fees which I will be going to charge. Otherwise, I will not accept that assignment. Many times what is happening is, when the assignment is taken, that point of time certification part is not clarified, or it is presumed from both the sides. And when this kind of a certification is there, there might be a bank which is giving you a fees of 5 lakhs, but you are testing the software, maybe any big company software which the bank has taken, and you are testing that software. So your testing fees are itself 1/3 of what you should be charging. And you're covering everything in that. So that's the biggest challenge before the auditor. My personal view is that if you are not adequately paid for any certification, one shouldn't be doing that certification job. Whether RBI dictates that or not, that is their prerogative. Auditor's prerogative is that whether to accept that assignment or not. So one can always say that, see, if I want to do this certification, this is X fees.
इसमें तो सब बैंक मर जाएंगे ना.
It's between banker and regulator. Auditor doesn't have any role to play, because auditor has never gone to regulator asking for this certification requirement. Regulator wants assurance from the auditor that the banks are complying the regulatory norms in terms of IRAC automation. I will give a second example, like priority sector lending, PSL certification. Now, PSL certification contains the data which is on quarterly basis, that quarterly basis data that is supposed to be certified by the statutory auditor. You take a case wherein under urban cooperative bank structure, barring very few banks, not even 10 banks I suppose, who have a structure of branch audits. Now for rest, all the banks, the structure is that there is only single auditor, single or joint auditors I should say, depending upon the size. Now take a case wherein say 100 plus branches are there in a bank. How that statutory auditor can really certify a priority sector lending? The reason being, unless and until you reach to the lowest level, in the sense you check the master data, you cannot certify it. Now here what the auditor needs to do, he has to do a ABC analysis, draw a proper sample, give that sampling technique categorically in the certification itself, and then only do the certification. So if you have done 10% testing, say that 10% testing is done, 90% is not tested. Now the challenge over here is RBI is given a prescribed format. It's a single letter format that is not as per the CA Institute's guidelines. CA Institute guidelines have a separate kind of format which is for certification and special reports. So ideally auditor has to follow that. Now that format includes everything, that what is the scope limitation, how the job is performed, in the sense how the verification has been performed. So ideally what the auditor should do, he should append that annexure which is in RBI format as an annexure to that certificate. So all your scope limitations are there. So if in PSL, if you are saying that across the section you have covered say top 100 accounts, and for balance you have taken a sample of whatever is the sampling technique you have followed, better to say that clearly. Challenge here for the auditor is that many a times in most of the banks the PSL data is not purified. So there are a number of versions which are given to the auditor. So first version, auditor will find out certain lacunas, then the second version is there, again third version, fourth version. So it's a never ending story. So what auditor should do is that at some point he should put a full stop by saying that that's it, I'm certifying that with a qualified remark. Now you and regulator can talk with each other, because I cannot go endlessly in correcting the data. I am not here to correct the data. In fact, I am here only to check that whether the certification is correct or not, in the sense the data which is given to the RBI is correct or not. If not, I have to qualify and say that clearly. If it is a minor mistake, it's fine that you can cure it. Other certification like DEF and other things, they are comparatively fair, in the sense I can at least draw the data.
So DEF has to be also generated through system, isn't it?
Yeah, but then I can generate it. There is no subjectivity for that. In the sense, based on data dump, I can pull out it, maybe 90% or 95% case. Priority sector lending is a Pandora's box.
No, it's a Pandora's box.
And I really don't know as to why a certification is required for something wherein the sample size checking, there is an inherent limitation on the statutory auditor as to how many samples he can check. Like suppose there are say 10 lakh accounts are there, how many samples a statutory auditor can check along with 90 days time frame given for audit.
Very true, very true.
And again, coming back to the same point, you need to ask for the fees for certification. Nothing is free actually.
There is no free lunch in this world. If
Yeah.
you want clarity and
Yeah, so depending upon complexity of the
yeah,
certificate,
yeah,
one has
yeah.
to charge, and the banker should
So
look at it in a
what
positive.
what regulator will do? And your statute, you break your heads and get the certificate.
Yeah.
So if here statutory auditor qualifies based on sampling, I don't think Reserve Bank of India will accept, because they want exact certification. कि ये बराबर किया है नहीं किया है, exact 100% certification they require.
Yeah. Now what is happening is the moment statutory auditor qualifies that, bankers are typically represented to the CS by saying the RBI is rejecting that without any email correspondence which is received to the auditor from RBI side that they have rejected. RBI has never communicated directly to the auditors. So even we as an auditor, we never know as to who has really rejected, because suppose I have given a qualified certificate, ideally the certificate should go as it is to the RBI,
Right.
and then RBI has to do any action
Further
or
actions,
whatever is there. RBI cannot reject my certificate because RBI has asked me to give a certificate, I have given a qualified certificate. It's like, rejecting a qualified report. If I qualify a report, RBI cannot say that you cannot qualify, and RBI will never say that. So this is a gray area wherein typically the bankers keep on harping to the auditors by saying that give a clean certificate, which may not be the reality in all the banks.
I mean, the firms which are willing to help the banks, they will give clean certificate, in the sense that if they know the bank, what kind
Yeah.
of things it is
But I will tell you the problem
they will run
in
the
that.
risk.
No, I will tell you the problem in that. See, whenever certificate is given, there is a UDIN which is generated. It's on a particular date.
Yeah.
Now take a case wherein as on that date, the data is X and later the data is changed. So based on X data, if you have issued a certificate, on that date the data purification should have already occurred, not later on.
Subsequently.
Now if it is proved that it is subsequently occurring, it means that the auditor has given a certificate without
Wrong
checking the
certificate,
data.
without
So that's
checking
where the auditor has to be careful about.
Right. There have been a couple of audit areas where the urban cooperative banks are not being so serious, or I don't know how to look at it. Audit of software systems, dealing room, treasury audit.
Yeah.
So this is a very big area, and banks are doing it for the sake of doing it.
Yeah.
The intention of Reserve Bank of India is to ensure that you really get your processes weighted from a third person who is not involved into a decision making process. That is the idea.
Right.
That you are not violating anything. Here what is happening is that the auditors are concluding, just say EDP audit hai. I mean, I should not say this, but EDP audit as a concept itself has lost its value.
Yeah.
But the circular is still there, so they ask, ye 3 branch ko kar diya. That kind of thing is happening. But that is not really achieving the results which is required as far as systems are concerned.
Yeah.
So what's your take on all these 3-4 areas which I talked about?
See, as far as software audit is concerned, mandating of software audit, one which we discussed earlier was about automation of IRAC, which is mandated by RBI. Others is like security audit, right, or IS audit, I should say. IS audit per se is not really a domain of CAs. It's a domain of experts actually, even though we call it loosely as auditors, but it's not a domain of CAs unless they are trained for that. Banks should exercise their diligence in appointing a particular firm or
Rightful
particular
firm.
Yeah, because they need to test that whether they are capable to do that thing or not. Just having a DISA or a CISA certificate doesn't mean that one is qualified to do that. One has to test the knowledge, one has to test the experience, and then only the work should be given. Now, whenever various softwares are used, if you want to use a CA, the CA's capability is more towards functional testing, in the sense they are domain expert, they are having a domain expertise. They may not be expert in the data integrity or security, but they can test the softwares. Like for example, if it is a dealing room audit, one can always test as to how the dealing room SOPs are operated, how the software is behaving. The behavior of software is something which typically a CA firm can do easily as compared to a technical person. But vice versa, if it talks about whether the flow from one software to another software is correctly happening or not, how the data structure is, you require a different kind of expertise. I'm not saying that CAs are not expert in that, but then while selecting a firm, one should ensure that they're selecting an expert. and not a novice who will test on you rather than he testing your various softwares. And another thing is that whenever a CA issues any certificate, it's always true and fair, which has to be understood by bankers and also the public at large.
Right.
So it's a true and fair framework.
It's not true and correct.
It's not absolute kind of assurance which is given. So it's not correct, or the word is not correct.
True and fair.
Yeah, true and correct was there up to almost, I think, 1950 or something. Since then, it is always true and fair.
Thank you so much, Dhananjay. You have done a fantastic job and tickle the hornet's nest. I mean, I don't know the kind of controversies how this particular video will create, but then at least it will start generate discussions among the interested parties, even with the regulators, because they need to approach to this particular area and revisit the guidelines. And this is part number one. As far as statutory auditors are concerned, they should take it with a pinch of salt. The questions which I specifically raised for only to ensure that all those CA firms which are doing statutory audit of urban cooperative banks need to take it with a pinch of salt and insulate themselves. Thank you for watching. You can ask a number of questions on the videos. The series of videos today ends here. You have my email. If at all you have a specific question to Dhananjay Gokhale, you send it to me. I will escalate to him. He will help you. And we are here to ensure that the urban cooperative sector becomes very strong and healthy and continue to fall in favor of Reserve Bank of India guidelines. Thank you so much. Thank you.
Thank you.